Hey there, this is Pat Ennis of Ennis Legacy Partners. Welcome to the Exit Readiness podcast. I'm here with co-host Walter Dial, CPA and tax partner at GRF CPAs and Advisors in Bethesda, Maryland. Our mission here on the podcast is to provide you, the business owner, with subject matter expertise on topics pertaining to building transferable or sellable business value, and then for planning your eventual exit from the business. We want to help you build a business that's transferable and then exit successfully on your own terms and conditions. In doing that, we want to help you protect the value of your business as well as maximizing it. And today we're going to discuss a topic that often comes up in client engagements in regard to employees and expense and risk management. And in an effort to reduce overall staffing expense, we're more and more seeing where employers are increasing the number of 1099 contractors while at the same time maintaining or even decreasing the number of W2 employees. And actually more and more employees want the flexibility and freedom of being independent contractors, it seems, and so hence 1099s rather than W2s. But there's areas of risk here that you need to be aware of and that need to be planned for and mitigated. And if not addressed, could have serious impact on the value of your business in the eyes of potential buyer and in the eyes of the IRS, actually. And so our topic today is W2s, 1099s, and protecting business value. And we're excited to have with us today Linda McNally. Linda is the founder of REIT Compensation Partners. Prior to launching her firm, she also served as VP of Comp and Benefits for LifeLock Corporation. She was the lead executive of compensation for Encana Corporation and the VP of Global and Executive Comp for Molson Coors. She's spent 20 years as a in addition to working internally for large corporations, she's also over time spent 20 years as a consultant with firms such as PricewaterhouseCoopers and Willis Towers Watson. She's a CPA. She holds a master's in taxation. She's a frequent speaker, various contexts on compensation related topics, focusing on M&A integration and executive comp. And she has experience designing comp structures for both private and public companies, to include engineering, real estate, mining, manufacturing, oil and gas, to name a few of the industries. And so we're excited to have her with us. Linda, welcome to the podcast. Great to see you today.
Thank you.
Hey, Linda, thanks for joining us. I'm going to start us off. The IRS has this crazy 20 factor test for employee versus contractor. They always like to kind of overkill. But, it's interesting. The thing I tend to see, which drives me crazy, is you're looking at a business and they've got a quote unquote contractor, and the contractor has no other source of revenue other than this business, and they're working full time, and their results are controlled by the business. And yet they're claiming to be a contractor. I mean, do you see a lot of this?
Yes. And at the end of the day, although there's that 20 question list, no one can do all of it, depending on the type of assignment you might be on. But at the end of the day, they're looking at the economic reality of the person and how they get their income, how they control their income. So beyond that, they're back in 2021, they kind of broadened the rules and said, at the end of the day, we want to understand the relationship that you have with your employer or the person who's contracting you and your economic reality. So if you are a contractor and you don't have any other clients, you don't market it, you don't have a business that you have online, nothing like that, then you are not a contractor. So what we see are people who retire potentially, and then they go back to the same employer and they're doing the same work. And that's not, and they decide they want to be a 1099 because they don't need benefits. Well, that's not the rule. It's not up to the employee, right, whether they're a 1099 or W2. It's up to the company, and the company needs to determine that. It's the company's risk at stake that is that's the most important thing to look at.
Yeah, and it's interesting because, a lot of, like Maryland just put in a provision where if you have a certain number of employees, you have to have a retirement plan in place. And then you have the healthcare rules that apply to only if you have a certain number of employees. So, I understand the motivation behind wanting to treat people as contractors, but this is an area the IRS definitely takes very seriously. And as Pat and I were discussing earlier, there's at least two major implications that we see when it comes to the work we do, which is, helping owners prepare for the successful sale of their business. And one is from a valuation standpoint, if I'm going to buy a company and their quote unquote key employees are contractors, that means they're not going to have, any type of non-compete agreements and things like that. And I mean, have you seen this where it just seems like the company wouldn't be as valuable because it doesn't have an in-place workforce, really?
That could absolutely be true because first of all, anybody in a leadership role who's setting the strategy, who's leading the company through its next phase in that way and has that accountability and responsibility is not a contractor. So, I mean, that's very clear in the rulings, because your economic benefit of the company is that you will make a fortune when it's sold. Well, that's not, then you're not a contractor. So you're an employee and you're part of that company. The other issue is you don't have retention issues. You might have a retention agreement with that contractor, but it's unlikely. Employees have retention agreements to keep the continuity when the business moves on, but it's not usually with the contractors. And in addition to that, the company is at risk for an awful lot of money when they get caught. They have to pay $50 for every W-2 they didn't file for years back. They'll go all the way back to when the person came on board. You have to pay 100% of your employer contribution on FICA. You've got to pay 40% fine. These are all fines. These are not just you have to pay them, but this is in addition to the payments. You have fines. 40% of the employee's contribution. And by the way, you have now filed everything late, and the penalties are extraordinarily steep. So the 941s are late, the unemployment files are late, the all your quarterly taxes are late. It goes on and on and on. So it's a very, very, very expensive proposition if you don't do it.
Yeah, didn't you have? Can you give us, without giving us the details? I mean, does an actual situation come to mind where the IRS audited, I guess, and found out that a business was behind in all of this, and it how much it did cost them? I mean, you've actually been involved with situations, right, Linda, where this has happened?
Well, most of the time when I find a client who's not correct in how they're filing people, I write them a memo. I explain to them, here's what you need to do. We evaluate their employees. I explain to them why those employees really should be W-2, not 1099. And so far, they have changed, and they've actually gotten people on the payroll. And try to explain things to them, like people can decline their benefits. They don't have to take them, and the employer doesn't have to pay for it. So as long as you can meet the requirements for the benefits, these employees who don't need the benefits can actually opt out. And so those kinds of rules people aren't aware of that. So they think they have to pay for all of this, and they really may not have to. Just depends. So the biggest situation is probably one of the most recent situations was, government contractor who worked in the field where he had left, and he built a firm, and all the people he hired were from the same government entity. So every time they won a contract, these people would come on board, but they were all retired, so they all wanted to be 1099. And that's an issue that you see that quite frequently, particularly in the government contracting realm, because people that they bring in are from the same entities that they're winning the contracts for. So that's one where the IRS knows about. They actually do audit the 1099s and how frequently you're issuing them to the same person year after year. And if they find a pattern, they will come in and start auditing and start looking at what you're doing and why you're doing it that way. And when I talked about the economic reality, if the only reason you have work as a contractor is because the entity that you're working for keeps winning bids, but you're not involved in the proposals, you're not involved in writing it, you're not out marketing, you're not out, finding new bids for the company to put an RFP in for. All of that looks at, well, what are you doing? You're basically in business because somebody else has won the bid, somebody else has gone to all the work to get you there, and now they're paying you to fulfill it. But you're not fulfilling it independently. You have a 100-page document that tells you exactly how you have to do it because it's a government contract. So you're not independent in your thinking. You might be independent in the day-to-day thinking about how to get things done and the issues that are present in that particular contract and how to resolve them. But other than that, you're really not independent. And if you don't have other clients and you're not marketing yourself as a company and you're not promoting yourself, then you're an employee. It's pretty black and white on that front. The other 19 questions on the list, that's only one of the questions. The other 19 questions are kind of old school. And are you sitting at the desk? Did they give you a laptop? I mean, that's just, some of those questions really don't make sense in today's world. And it's not a mathematical thing where you add it all up and say, well, I've got more on the no side than the yes side, so I must be a contractor. It's not that. At the end of the day, they look at economic benefit and who's doing what and who's in control of the economy of the company.
Yeah. So Linda, the other area Pat and I kind of identified as important to the type of work we do would be in the due diligence process. Because if you're a buyer of a company and you come in and it's, gee, there's no payroll, but we got hundreds of thousands of dollars of contractors. I mean, no one's going to want to take on that liability. You just did a great job of describing what they could be facing. No one's going to want to deal with that, right?
That is true. And they will, interestingly, is one of the things that's not emphasized when I do due diligence. I actually tell people we need to look at this. We need to understand what the potential liability of this company is. Should the IRS come in later and look at this, or if some employee decides or a contractor decides, I should have had benefits. Now I'm going to go back and claim with DOL that I was misclassified. So we need to understand who these 1099 folks are and make sure they were legitimately 1099 and resolve it before you go through the closure of the action, and make sure that everything is resolved.
Yeah, and you just made a really good point, because I think some people are willing to play the audit roulette game without realizing that what you just described, an employee could decide, hey, you know what, I really wish I'd been an employee all these years. I'm going to DOL and telling them I should be. Yep. So there's more than one way that they could be discovered if they're not doing it right.
Absolutely. In fact, in the beginning, that's how most of the larger West Coast companies were caught. The employees were raising their hand and filing suits against the companies to say, we should be employees. We don't get benefits. And they won. The employees won. But so when we talk about the cost, it's not only all the tax filings, but you have to go back and pay for the cost of the benefits that were lost by the employee. So that, for the number of years that they were a contractor, not an employee. So when you add all of that up, that's quite a lot of money, plus, interest and things like that. And then there's more penalties on top of that. It's a huge number. If you get caught and you've got depending on the size of the number of 1099 folks versus W2'd.
Yeah. Wow.
What's the short term? Clearly, employers can be motivated maybe by short term benefits without having the long term ramifications in view the way they need to. What are the short term benefits? Can you summarize those yet again, Linda?
Yeah, there are a few. I mean, you don't have to do all the tax filings if they're 1099. However, depending on the type of work your company does, if you aren't carrying workers' compensation on those people, you have a real problem if they get hurt. So I see this in smaller construction companies. They 1099 folks, or they pay them under the table. Somebody gets hurt. Oh, and lo and behold, now they want you to pay for the medical, and they actually file a lawsuit. So there are other ramifications. It's easier. It's just easier to hand them a check at the end of the day, and there's no issues around how to sever somebody, how to put them on notice if you want to fire them, the benefits issues of what's required in any jurisdiction. You don't have to do filings all the time with the IRS for your employees. You're not filing W2s, although you do have to file your 1099s. It's kind of the same bucket there. But it's easier to get people in the door without all of the onboarding issues that a company can sometimes put in place to make it difficult. And you don't have to deal with a payroll vendor, which costs money. So you're basically writing a check as opposed to dealing with payroll and payroll withholdings. So it's just when you add up all the different pieces and the costs, it actually is less expensive, but only if A, you don't get caught, and B, that at some point nothing bad happens to an employee along the way. And the people who are working for you just want the money, especially if they're retired or they just want the cash. They don't really want all the other bells and whistles of being an employee. They don't either. And so, they come to an agreement and say, I don't really want benefits. Can I just be 1099? Oh yeah, sure. We'll 1099 you. But that's not a great strategy for a business, either as a continuing entity or as one who's trying to sell itself. It's not a good strategy.
Yeah. Hey, Linda, let me ask you a question. So, a lot of our client base are just these single member like S corps. And a lot of them are government contractors, and like you described, they're usually contracting to a prime. But do you agree that if someone has set up an S corp and the payments are going to their S corp, they're safe? Or have you seen where the IRS has tried to even pierce that?
They're not really safe because with an S corp, you have to take a reasonable compensation wage. So you must pay yourself a reasonable compensation wage. And if you're not doing that, you've got your own issues there about the fact that you weren't recording wages. So that's one issue. The second is then whatever is beyond your reasonable compensation wage based on what you're doing and the hours you put in and your proficiency, et cetera. There's a whole bunch of issues you put in there to calculate what your reasonable comp is. The rest of it flows through as profit. And if you have an enormous amount of profit going through, the IRS is going to look at your return, not the company's return. They're looking at your return because they want to know why they're going to assume your reasonable compensation is not correct. And then they're going to look at you as an entity and they're going to start asking questions in the audit, and that you could get caught there. The company could then get caught because you're filing like that. At the end of the day, they don't really care what kind of tax return you're filing, whether it's a Schedule C or a 1120S as an S corp. What they want to see is that you have other clients, that you market yourself, that you have a practice. Now, you could be a 20-hour work person and say, I do market myself, but I always work 20 hours a week. And that's fine. You don't have to work 60 hours a week to say you have your own business. But you have to market yourself, and you have to promote, and you have to have other referrals, and you have to have other clients besides the one client you're continuing to work for as a contractor.
Yeah.
And that's the biggest issue. They don't have other clients. They get a lot of business, but especially in government contracting or small companies, the work just keeps coming in. The person bringing in the work, though, is the one who is hiring you as the subcontractor. So you need to have your own returns and your own ducks in order to be viable from the IRS's perspective.
Yeah, and I think the government contractor area especially is susceptible to this, because I've got a few clients who, they worked for a big government contractor on site at a client's. The client decided they didn't want to pay the big contractor anymore, but they wanted to keep this guy around. So, that's just the perfect setup for this type of situation. So definitely need to be careful.
Yeah.
And I think, in the old days, I remember this is probably over 20 years ago. That's the last time I've had one of these 1099 audits. Might have been 30 years ago. But it was interesting because they used to have this, they looked at what there were some industries where it was kind of more acceptable for 1099s, and they had like an industry exception where you still had to do everything right, but I think they cut way back on the penalties for you. They kind of gave you a one-time chance to get right, but they're much more strict nowadays.
Yeah, and if you're a small company and you hire, especially you see it in anything that has to do construction related, like you're doing the exterior work on buildings, and you keep getting new projects, and you bring in people when they're available, and you bring them in for a project, but you don't want to keep them on as employees because you know that project ends and you may not have another one. Or landscaping does this, or those kinds of smaller companies. If you're caught the first time, you haven't been in business for a long time, the IRS will cut you some slack. You do have to pay the FICA taxes, and you do have to make sure the employee is correctly set up, and if you were offering benefits to other people, then you have to go back and make sure they've been cashed out for the benefits that they should have had. But they're not going to nail you as much as they would, without mentioning names. It's people on Silicon Valley who had thousands of 1099 contractors back in the day. So they're going to give you a little bit of a break, but if you ever do it again, then you're in bad trouble. And then people will ask, well, what's the chance I'll get audited? I mean, they're going to go after the big folks, like, well, that's true. However, there are people who they're hiring who do nothing but work with small businesses. That's the group. They don't work on the large corporations. They work on the small businesses. So, I wouldn't use that as the excuse to think you're going to get away with it. Lots of people do. Lots of people get away with it, but I wouldn't want to be on the other side of the table for that one, especially if somebody became injured on the job. Then you've got a huge liability. And your insurance from a company perspective could also be impacted. So if you had 1099s, you weren't insuring, your insurance didn't cover your contractors, they only covered your employees. Something happens to one of your contractors, now your insurance is impacted as well.
Yeah. Yeah, and I think, like you mentioned, seasonal businesses are probably really tempted to do this because of the unemployment costs when they let people go.
Yeah, depending on where you live, that is true. So, you can, with contractors, you can put things in their agreement letter. It's a one-pager, and you just say, if this happens, we're going to let you go, and we'll give you a week's notice. So there are ways to kind of get around it and cushion it so that you're not impacted. You just have to get that agreement letter signed. And you have to make sure that it's that the conditions by which you said you would let people go without notice, or in some states you can't even do it without notice, that you would be able to show that you actually met the requirements. And a week's notice or 2 weeks notice is not, especially if you're looking at the average income, if it's volatile over that time period of the contract, you can use an average, or you can use a most recent. So it just depends on what would be most fair to the employee. And if you try to use the lowest number possible, the IRS will push back on that. But so an average is usually pretty good, because there are times when you may make more money than others, particularly in any kind of construction type business, or any kind of landscaping or seasonal work business.
Linda, in my opening comments, I mentioned protecting business value, and how Walter and I, with the work that we're doing, as we're helping owners to build in a way that they can maximize value when they transition out of the business. And we're agnostic, sale to insiders, transfer to kids, ESOP, sale to third party. We just want to help them figure out the best route and put a plan in place to make it happen. And foundational to that plan is maximizing value and protecting it. And protecting it often looks like just identifying areas of risk, and knowing what they are, and then deciding how you're going to mitigate the risk and manage them. In your words, how do you see what we're talking about here as an area where, by attending to it, indeed you are protecting the value of your business?
Well, this absolutely does protect your business from a number of fronts. And you want to make sure that there's nothing that the IRS or legally can be held against you. So if you're not paying employees benefits because you're putting them on as a contractor, that's one issue where the employee can always raise their hand and come back at you. And there's no time frame in which they have to do this. I mean, they can't come back 10 years later, but they can come back within 2 or 3 years. So if if they raise their hand 2 years down the road, all of a sudden you have a risk and you've now got a lawsuit on your hands, which now has to be divulged. And so you have all the, your business is no longer as stable as it looked. You could have a lawsuit. The IRS could be coming in after you. You've got huge, you've got IRS notices, and they will levy your business, by the way. If you can't pay and you won't work out a reasonable arrangement to make the payments that you owe, they will levy the business. So now you've got a risk on that side. So it's just like anything else. It's almost an insurance. How much risk do you want to take, and how much do you want to self-absorb the risk? And quite frankly, because this is illegal issues that will come out of this, it's a higher risk than other types of things that you could be doing in your business that maybe not be as I won't want to say ethical because that's the wrong word, but aren't as correct as perhaps they should be. But this is one where it becomes a legal issue. And so now you've got a legal problem, and you don't want it to go down that path ever, right? Any legal problem within your business. So it falls into that bucket, unfortunately.
Yeah. So, and let's talk about due diligence again for a second, because I think a lot of small business owners think that, okay, I've decided I'm going to sell to a third party. So when I'm ready to do that, I know there's going to be due diligence, but I'll get it done in 6 months or whatever. And we're always saying, no, you know what? You should be thinking about this years in advance and getting the right practices in place. If a potential buyer comes in, does their due diligence, they're going to be looking at this, right? And then if they find stuff here in this area, how long would it take to get it straightened out to the point where a potential buyer might be comfortable with it?
Well, you can do a voluntary corrective action. And as soon as it's identified, you can file for that. You can work with the IRS. You can negotiate your penalties down and your fines. And you can go back and you can rectify it. It doesn't take long, actually. Now, they will want to come in and audit to make sure that they've caught everybody. And they will go back even beyond the current 1099. So they will go back and look at the last few years to see how many 1099s you kept, so they make sure they have the whole bucket of it. But if you proactively file the voluntary correction and then you go through it with them, it can work pretty quickly, but it will take 6 months at least for the IRS. They're very busy. They're understaffed just to read the paper, but so they will take a long time to get it done. And so if you have all of your documentation in order and you've got everything documented, you've gone far enough back, 4 or 5 years back, and you show them how you're correcting it, what you're doing, it moves a little quicker. But if they have to hunt and find things, it'll take a lot longer, and that will impact your ability to move forward with whatever your plan of exit is. And no one wants an IRS thing hanging over their neck when they're buying a company. So a lot of times in an M&A, whoever's buying it will say, you're on the hook for that. We're not absorbing that, if they can legally, depending on the situation of the purchase. But the problem is it could hold it up. They may walk. They may say, we're going to go look at somebody else's company because we don't want to be entangled into this. It's the IRS, for heaven's sakes. And then once you open the books to the IRS, you open it for everything. So it can be a challenge.
Yeah, so this is a great example, Walter, isn't it, of an area of risk that you would be well advised to just assess well before you're going to be in a due diligence process, because due diligence is tough enough as it is. Owners can take their eye off the ball, the business during due diligence, and the business can suffer some. You don't want things like this to come up during due diligence. You want to know about them well in advance so you can get it all taken care of before you get into that due diligence process. Because if it comes up then, nothing good is going to come from it, right, really, in regard to the transaction, the potential transaction.
And it also begs the question, what else have they not been doing correctly?
Right.
So you start to delve in a little bit more once you find anything, this or anything else. Buying companies or whoever's doing the due diligence on their end is digging in deeper to say, what else should we look for? Because they've discovered something. So that's not a good place to be either.
All right. So in closing, this has been fantastic. I know listeners are going to benefit from this content today. Linda, closing question. In regard to situations you've been involved with where there has been an audit, they've got caught and had consequences, what kind of advice were either they getting along the way and ignoring, or what kind of advice should the business owners been getting and benefiting from to have this in order?
Well, the first thing they should be doing is, if anybody is talking about compensation with them or benefits, whoever is doing that work should be looking at how many 1099 employees they have versus W2 employees. And they need to be making sure that's part of their due diligence when they go in to do any project for a company. And a lot of consultants don't do this. They just do question ask, they want a comp structure, question ask, they need health benefits, and they don't go further. And I would say, whoever your consultant is, make sure they're looking at this, because you may not even realize you're doing something incorrectly. Honestly, a lot of people don't know that they're doing it incorrectly. They think they're okay. So that's the first thing, is make sure you've got the right consultant who's going to dig a little deeper for you and make sure you're excluding the right people and make sure that they're supposed to be excluded and can be. And then on the second side of it, there are people who ignore the advice. There's nothing you can do at that point. They ignore the advice, but you just can remind them. Sometimes if I know they're ignoring the advice, I'll email them every 3 months and just say, hey, just wanted to know if you needed more help on that 1099 issue, or are you good? Are you moving it forward? Have you talked to your accountant? Have you talked to your lawyer? Did you get it reviewed? Where did you end up? Just to prompt them to keep it in front of them. 3 months can go by very quickly in a business. So, just remind them that it needs to be out there. And at the end of the year, they're filing all their W-2s and 1099s. That's a great time to, to remind them as well, to say, what did you end up doing? Did you convert people during the year? You've got both the W-2 and the 1099 file. are you going to do it this year? When are you going to do it? So just reminders. And often they'll finally pick it up and say, yeah, I need to get to this. I haven't had time. But it's not worth it to not have time. And again, if you're hiring retired people that don't care about the benefits, that's why they would prefer to be 1099. However, the people who you might be hiring who are not retirement, don't have lovely retirement benefits, particularly from the government, may not appreciate that as much. And you don't want them, because they actually file a claim against DOL for you. And so you don't want a DOL claim sitting on your books when you're trying to sell your business or exit out or plan a strategy.
No, that can't be good.
No.
Okay. So listeners, please, we would just exhort you strongly to attend to this issue now and protect the value of your business, and don't wait to a due diligence process to take a look at this and mitigate the risk. Linda, thanks for joining us. Is there 2 questions? If someone listening wants to contact you directly, how would they do that? If you want to share your contact information. And then 2, is there anything that you'd like to promote today?
There's just a lot of good, compensation is kind of a whirlwind right now. There are lots of people who are coming in the door saying, I want X dollars to pay. You don't need to necessarily do that. It's the package of what you're offering them. And part of it, especially in a smaller company, in a startup, it's the breadth of work they'll have the opportunity to do, which is of value to them. And so being able to pitch that value of coming to work for you and what's in it for them besides the paycheck is another way to look at compensation. And that is something that a lot of companies are starting to look at now, because yes, people need to make money, especially if you're paying hourly folks and you've got kind of a labor workforce, that sort of thing. They need the paycheck, but there's other things as well that they need. And there's cheaper ways to get there than just writing higher paychecks all the time and higher hourly rates. So being able to strategize around the best way to offer your employees what they most need is a great way to do it. And that's something that these days I do quite a lot of, even large companies and small companies, including singly owned 1120S filers and subchapter S companies. They need to be able to keep their employees because they can walk across the street and get a job somewhere else, or and it's tough keeping pace with people like Starbucks and McDonald's who are paying $20 an hour when you were paying $20, $15, $17, $18 an hour to people who are doing labor work. It's difficult. So how do you put the package together for them, but keep your expenses reasonable at the same time? That's a big area. And if people want to contact me, it's well, the email address is linda.mcnally@aretecomp.com. And the phone number, my business number is 509-847-8464.
Fantastic. And listeners, if you want help in maximizing and protecting the value of your business or planning for your eventual exit, you can reach Walter at 301-951-9090. You can reach me at 301-859-0860. If you've benefited from today's episode, please consider liking it and sharing it throughout social media. We really appreciate that. Thank you for listening. And until next time on the Exit Readiness Podcast, this is Pat Ennis and Walter Dial signing off.